Hi there, my name is Scott Rockins. I'm a mortgage broker with Dominion Lending Canada, and this is one of my informative videos to talk to you about how to speak like a banker, or what it is that my banker or my broker is saying to me when they use certain words, because they're words that are really unique to mortgages. So today we're going to talk about interest rates, something everybody talks about. You see it in the newspaper, you see it on the news, but there's a lot of misunderstandings around these topics. So first, we're going to talk about the two basic types of interest rates. A fixed interest rate, the most common, means that your interest rate is going to be the same for a certain number of years or a certain term. So my interest rate is fixed at 4%. It means I get 4% for 5 years, whatever my term is, 3 years, 5 years. So that's fixed. Variable is a floating rate, depending on economic conditions and what the Bank of Canada does in Canada. Whether it's a booming economy, it's going to go up. It's a slower economy, it's going to go down. But my payment and my interest rate are going to fluctuate with the economy. That's variable. Now, two words that are thrown around but not often understood are open mortgages and closed mortgages. These are different than fixed and variable. A closed mortgage, the most common type, is a mortgage in which you must pay a penalty to renegotiate, pay off more than a certain amount, sell your property. You're going to have to pay a penalty if you do a number of different things. Now, how much that penalty will be will vary, but in a closed mortgage, which could be fixed or variable, you will have a penalty to remove yourself from that arrangement. Now, there's also an open mortgage, and an open mortgage is very much different. You can remove yourself from that mortgage arrangement at any time with a very small charge, usually administrative charge of $100 or $200. So they tend to be more expensive because of this, because the bank's looking at it like, okay, so if you're going to commit to me for a certain term, let's say 5 years, then I'll give you 4%. And if you break the arrangement, then I'll charge you a penalty. So I hope you don't break it, but if you do, I'll take a penalty. And an open arrangement, the bank's going, okay, so if you aren't going to commit how long you're going to stay with me, then I'm going to charge you a higher interest rate, but I'm going to let you leave at any time. So if you're selling, this is really useful, although more expensive. And if you're not sure how long you're going to keep the property, because it's maybe an investment or something, you might want an open. And they tend to be more expensive, but it depends on the market conditions. So fixed, variable, open, and closed. You can have different combinations of all the different things. If you want more information about any of that, just give me a call. My contact information is at the end of this video. Thanks for your time. Have a great day.